Every single time you ask an advanced AI to, generate an image or write a block of code, you are essentially boiling a cup of water.
Yeah, that is the harsh physical reality of the cloud.
Right, because we use these really lightweight, kind of ethereal words for it all. We say cyberspace or the digital realm or, neural networks.
Exactly, and it completely conditions us to think of artificial intelligence as something weightless, like it's just floating out there.
But the AI revolution isn't just this clean software boom. It is rapidly becoming, quite literally, a global heat crisis. Have you ever wondered what keeps the cloud from literally melting down?
It is arguably the most severe physical bottleneck in technology right now. And yet outside of, specialized engineering circles, it's largely invisible to the public.
Which is crazy because it's so critical.
It really is. We've pushed computing to a point where the fundamental laws of thermodynamics are fiercely pushing back.
And that brings us to the core mission of today's deep dive. Welcome to Talk Tickers, where we break down corporate earnings calls for retail investors.
And today we have a really fascinating one.
Oh, absolutely. We are unpacking the Q3 2026 earnings call for Johnson Controls International, or JCI. We've got the full transcript, the analyst Q&A, the financial notes, all of it.
And our goal today isn't just to rattle off standard financial metrics, right?
No, definitely not. We are using this company, a 140-year-old industrial manufacturer, mind you, as a lens.
Yeah.
We want to understand the massive infrastructure shift happening underneath the AI boom.
Yeah, what their CEO is explicitly calling the age of thermal management.
The contrast here is what makes this so compelling for an investor. The market constantly obsesses over the chip designers, the large language models, the software guys.
Right, the flashy stuff. But you can have the most sophisticated silicon on the entire planet, and if you cannot physically extract the heat it generates, that chip will thermally throttle within seconds.
It essentially becomes a multi-million-dollar paperweight.
Exactly. The true constraint on AI scaling isn't just algorithmic efficiency anymore. It's industrial plumbing, thermodynamics, and the electrical grid itself.
So let's jump right into the story behind the numbers and ground this in what's actually changing. We've had data centers for decades. The internet hasn't melted down yet.
Well, not completely.
Right? Not yet. But early in this earnings call, JCI's CEO, Joakim Weidemanis, states that we are entering an entirely new era. What is fundamentally different about an AI factory today compared to a normal cloud data center from, say, 5 years ago?
It all comes down to rack density. So a traditional data center, the kind hosting websites or standard enterprise software, it might have a power density of maybe 10 to 15 kilowatts per server rack.
Okay, 10 to 15. Got it.
At that density, you can use a classic raised floor design. You just pump cold air into the room, blast it through the floor tiles, and blow it across the servers with massive fans.
So basically just a giant, highly air-conditioned warehouse.
Precisely. It's brute force, it's highly inefficient, but it works fine because the thermal load is manageable. Air can handle it.
But AI changes that math completely.
Right. Oh, entirely. AI workloads require parallel processing on GPUs, which are incredibly power hungry. When we look at the latest generation of AI hardware, we aren't talking about 15 kilowatts per rack anymore.
What are we talking about then?
We're staring down the barrel of 100, sometimes 120 kilowatts per rack.
Wow. Wait, that is almost 10 times the heat?
Exactly. The localized heat signatures coming off these racks are unprecedented in commercial computing. Forced air physically cannot handle that density.
Because air just isn't dense enough to absorb the heat.
Right. Air is a fundamental insulator. It just doesn't have the heat capacity to strip that much thermal energy away fast enough.
And if you can't strip the heat away, the chips slow down to save themselves from catching fire, which means the operator is losing massive amounts of compute power and revenue.
Yeah, it's a massive financial loss. But the heat is really only half of the bottleneck here. The transcript heavily emphasizes the constraint of the power grid itself.
Right, I noticed that. The power grid is a huge theme in this call. Why is that such a hard wall for these companies?
This is where the physics problem becomes a massive economic problem for retail investors to pay attention to. The power grid in major data center hubs, places like Northern Virginia or Dublin, is largely tapped out.
Tapped out meaning utilities literally cannot build new substations fast enough.
Exactly. So if a hyperscaler like Google or Microsoft secures, say, a 1 gigawatt power agreement for a new campus, that is a hard ceiling. They have 1 gigawatt total.
So they have a strict energy budget.
Yes. Now, Every single watt of electricity they spend spinning a cooling fan or running an air conditioning compressor is a watt they cannot spend powering an AI chip.
I see. It's a zero-sum game inside that building. The cooling system is actively cannibalizing their revenue-generating compute capacity.
That is exactly it. And that zero-sum dynamic is what sets the stage for the massive technological breakthrough JCI introduced on this call.
Yes, the AI Factory Absorption Chiller. Let's really dive into the mechanics of this because the claim in the transcript is staggering.
It really is a game changer.
JCI states, this chiller can reduce a facility's cooling electrical demand by approximately 44%. Cutting energy use almost in half in an industry where power is the ultimate currency feels like a total cheat code.
It honestly sounds like a violation of the laws of physics at first glance.
Right. Converting waste heat into productive cooling is so counterintuitive. How do you take the massive heat coming off these servers and use it to make the facility colder?
So it relies on what's called an absorption refrigeration cycle. To understand why it's revolutionary, we have to contrast it with standard cooling.
Okay, walk us through the standard way first.
A traditional air conditioner uses a vapor compression cycle. It uses an electric motor to drive a mechanical compressor, which squeezes a refrigerant gas. That raises its pressure and temperature so it can release heat outside.
And the mechanical compression is what draws all the electricity, right? Those massive motors.
Exactly. Those compressors are what eat up the data center's 1 gigawatt budget. But an absorption chiller completely eliminates the mechanical compressor.
Wait, it just gets rid of it. Then how does it compress the refrigerant?
Instead of using electrical work to compress it, it uses thermal energy. It uses raw heat to drive a chemical process. JCI's system uses a solution of water and lithium bromide in a closed loop.
Okay, water and lithium bromide.
Right. Water acts as the refrigerant, and the lithium bromide acts as the absorbent. And here is the genius part. The energy to run this comes directly from the server racks themselves.
No way.
Yes.
So the hot liquid from the chips powers the cooling.
Yes. The blazing hot liquid coming off the AI chips is piped right into the chiller's generator. This intense waste heat boils the lithium bromide and water solution.
Because it's under a vacuum. Right, so it boils at a low temperature.
Precisely. The water flashes into vapor, travels to a condenser, then an evaporator, where it provides the chilling effect for the whole facility. And the cycle repeats.
So you are literally substituting expensive electrical energy with the raw thermal energy generated by your own problem. You capture the waste heat, feed it into this chemical loop, and it cools the building.
You are turning the ultimate liability into an asset. Now, connect that back to our zero-sum power grid scenario.
Right, the 1 gigawatt hard limit. If your cooling system suddenly requires 44% less electricity to operate, you have all this surplus power.
And what do you do with that surplus power?
You definitely don't give it back to the utility company. You redirect it right to the server floor and plug in more GPUs.
Exactly. And this answers a key financial claim from the transcript that I know caught your eye. The CEO mentioned this approach can generate more than $100,000 of additional revenue over the life of a 1 gigawatt facility.
Yeah, that specific line really stood out to me. When I first read it, I had to pause. An air conditioner is a cost center, right? You buy it, you maintain it, it drains power.
Normally, yes, it's just an operating expense.
So how does an HVAC system generate top-line revenue? But based on what you're saying, the cooling system is physically unlocking stranded compute capacity.
It acts as a direct enabler of revenue. Because AI compute time is rented out to developers at a massive premium right now, every additional server you can power translates directly to billable compute hours.
Which fundamentally revalues the company providing the thermal management. They aren't just selling infrastructure anymore. They're essentially selling compute capacity masquerading as infrastructure.
That is a massive paradigm shift for how investors should view this stock.
And a compelling technological narrative is great, but it only matters if the hyperscalers are actually buying it. So let's look at the headline numbers from Q3 2026.
Let's do it. The numbers are incredibly strong.
They really are aggressive for a legacy industrial stock. Order momentum sustained above 25%. Organic revenue grew by 10%.
Both very solid top-line figures.
But the metric that really demands scrutiny and what investors care about is profitability. Their adjusted earnings per share, the EPS, increased 35% to $1.42. They comprehensively beat their own guidance.
The spread between the revenue growth and the profit growth is the real story there. In the heavy industrial sector, achieving 10% organic top-line growth is great.
But seeing the bottom line earnings jump 35% on that same revenue increase, That is exceptional.
It implies a dramatic improvement in their underlying operational efficiency. They aren't just selling a higher volume of chillers. The unit economics of what they are selling have fundamentally improved.
Yeah, the CFO, Mark Van Dippenbeek, quantified that. He noted their adjusted EBIT margin expanded 260 basis points to 17%.
Which is a huge jump for a company of this size.
Right. For retail investors listening, EBIT is earnings before interest and taxes. Basically the profit from core operations. A 260 basis point expansion means their profit margin jumped by 2.6 percentage points.
In a multi-billion-dollar industrial operation, finding an extra 2.6% in margin usually requires massive, painful corporate restructuring. But JCI seems to be achieving this entirely organically.
Which points to immense pricing power, right?
Absolutely. When you have a highly differentiated technology like an absorption chiller that solves a critical bottleneck for a trillion-dollar tech company, you aren't competing on price.
You aren't offering 20% off to win the contract.
Exactly. You can command premium pricing, and that premium falls straight to the bottom line, driving that massive margin expansion.
That pricing power is clearly visible in the backlog, which brings us to the $21 billion elephant in the room. Their backlog increased 32% year over year to a record $21 billion.
It's an incredible number.
But let's unpack the reality of a number that large. A massive backlog is generally celebrated on Wall Street, sure, but isn't it also a massive operational liability?
It absolutely can be, yes.
Because if inflation spikes or raw material costs surge or supply chains freeze over the next 2 years, JCI is legally on the hook to deliver $21 billion worth of equipment, and potentially at prices they locked in today.
It is the defining risk of industrial manufacturing. A backlog can become a total trap if you aren't strictly disciplined with your contracts.
So how does an industrial company actually hedge against a backlog that massive without exposing themselves to margin collapse?
The way companies like JCI navigate this is through inflation escalation clauses embedded in these long-term agreements. They don't just lock in a flat price for a chiller being delivered in 2028.
Okay, so how do they price it?
They index the final price to specific commodities, things like copper, steel, and even local labor rates at the time of delivery.
So they basically pass the macroeconomic risk right back to the hyperscaler.
To a large extent, yes. And from the hyperscaler's perspective, they happily accept those clauses. Their overriding priority is just guaranteeing their place in the production line.
Because the wait times are getting ridiculous,
Yes,
right?
Exactly. The lead times for mission-critical infrastructure are currently stretching out 18 to 24 months. The massive tech companies are literally hoarding these future production slots.
So for JCI, that $21 billion represents absolute operational visibility. It de-risks their capital allocation because they know exactly what they need to build and when.
They can schedule their factory floors years in advance. It's a huge advantage.
Let's break down where that $21 billion is actually coming from regionally, because the geographic split tells a fascinating macroeconomic story.
It really does. The regional differences are stark.
In the Americas, orders were up a staggering 37%, explicitly driven by data centers. That aligns with everything we know, right? The U.S. is the undisputed epicenter of the AI build-out.
Unquestionably. But the Asia-Pacific region, APAC, also grew 12%. And the CEO highlighted a nuance there that really caught my attention.
Right, it wasn't just data centers driving growth in APAC. He specifically called out Japan as a highly active market, but cited advanced biopharma and semiconductor manufacturing as the primary catalysts.
This is a vital reminder for investors that mission-critical thermal management is a much broader category than just AI server farms. Let's look at semiconductor fabrication for a second.
The chip factories.
Right. A modern fab utilizes extreme ultraviolet lithography machines to etch circuits onto silicon wafers at the nanometer scale. These machines generate an immense thermal load.
And they're incredibly sensitive, right?
Unbelievably sensitive. The environment around them, the clean room, has to be regulated to microscopic tolerances. We are talking about class 1 clean rooms where a single degree of temperature fluctuation can be catastrophic.
A single degree.
Yes, a slight change in humidity or a single microscopic dust particle can completely ruin a batch of silicon wafers worth millions of dollars.
So the thermal management required isn't just about extracting heat. It's about absolute, unwavering atmospheric control.
Exactly. And the same strict logic applies to advanced biopharma in Japan. Bioreactors cultivating complex proteins or cellular therapies require incredibly strict thermal regulation to maintain cell viability.
And Japan has been heavily incentivizing the onshoring of these industries recently.
Right, to ensure supply chain resilience. This requires the exact type of high-performance precision environments that JCI specializes in building. So they are capturing the AI wave in North America while simultaneously capturing the advanced manufacturing wave in Asia.
It's a powerful dual-engine growth narrative.
Yeah.
But that momentum hits a serious wall when we look at the EMEA region, Europe, the Middle East, and Africa.
Yeah, that was the weak spot in the geographic data.
Orders there only increased 6%, and actual sales only increased 1%. That is a significant lag compared to the rest of the world.
The transcript attributes this primarily to the ongoing geopolitical conflict in the Middle East. The CEO noted that region accounts for about 10% of their EMEA business.
But is a localized conflict in the Middle East enough to drag down the entire European and African portfolio to just 1% growth? That seems disproportionate.
It's a localized anchor, but it has regional ripple effects. The CEO used the phrase building pent-up demand. What happens in these geopolitical scenarios is that capital expenditure just freezes.
So the projects aren't canceled, they're just paused.
Right. The infrastructure projects are budgeted, the blueprints are drawn, but the actual deployment of capital and the breaking of ground are paused due to uncertainty. JCI isn't losing those contracts to competitors.
The contracts are just sitting in stasis. The demand is deferred, not destroyed.
Correct. And to the CEO's credit, he was very pragmatic about it on the call. He stated they are not modeling a sudden resolution into their near-term forecasts.
Which is the smart, mathematically prudent way to manage Wall Street's expectations. Better to underpromise and overdeliver.
Exactly. Assume the drag continues, and if it resolves, it's upside.
Now, regardless of the EMEA drag, managing a pipeline that is exploding in the Americas and growing steadily in Asia requires incredible operational discipline.
It's a massive logistical challenge.
Right. With orders up 37% domestically, the immediate question for an investor is execution. How does an industrial manufacturer scale their physical production to meet a spike of that magnitude without their factories descending into utter chaos?
And that's where the transcript spends a significant amount of time detailing their internal methodology. They are heavily anchored in a proprietary business system based on the concept of going to Gemba.
Gemba, what exactly is that?
That's a Japanese term, fundamentally rooted in the lean manufacturing principles pioneered by Toyota decades ago. It translates to the real place, or the place where value is created.
So it's a management philosophy.
Yes. In corporate management, it dictates that leaders must leave their offices and go down to the actual factory floor to observe the work as it is physically happening. You don't solve bottlenecks by staring at a spreadsheet on the 5th floor.
You solve them by standing right next to the assembly line. It sounds like standard corporate hygiene, honestly.
It does sound like a buzzword, but they presented a specific case study during their recent investor day that elevated this from jargon to hard, verifiable results.
Right, the ACE facility. They took analysts to their airside center of excellence. This facility manufactures critical airside technologies, specifically computer room air handlers.
And by applying this Gemba business system, the management team claimed they more than quadrupled their capacity on that specific manufacturing line.
And crucially, the CEO emphasized they did this without significant capital investment. How is that physically possible? Quadrupling output usually implies building huge new facilities and buying millions in new machinery.
It all comes down to the relentless elimination of muda, or waste, in the manufacturing process. When you deeply analyze a traditional assembly line, you find that a massive percentage of the time is spent on non-value-added activities.
Like what kind of activities?
Workers walking 50 feet across the floor just to retrieve a specific tool. Components sitting in a queue for hours waiting for the next station. Excessive work-in-progress inventory just cluttering up the floor space so people can't move efficiently.
This is mostly just an optimization of physical flow.
Exactly. Let's visualize it for a second. Imagine a sprawling industrial kitchen. The chefs are talented, but the layout is totally chaotic.
The prep station is 50 feet from the stoves. The walk-in freezer is in the basement.
Right. They can only serve 100 meals a night because they spend most of their time just walking around looking for ingredients. If you shut down that kitchen and totally redesign the flow, placing the prep station directly adjacent to the stoves, installing point-of-use refrigeration, you fix it.
You don't need a bigger building or more chefs to serve 400 meals. You just remove the physical friction.
The metrics they achieved at the ACE facility reflect exactly that kitchen analogy. They achieved 100% on-time delivery. They cut customer lead times entirely in half.
And they reduced the required manufacturing floor space by more than 30%, all while slashing inventory by 50%. Those are phenomenal operational numbers.
And this is the direct catalyst for that margin expansion we discussed earlier. The CFO continuously referenced operating leverage, projecting it at 45 to 50% for the full year.
Let's translate operating leverage for the retail investor. It basically measures the relationship between fixed costs and variable costs, right?
Correct. If a company has a high proportion of fixed costs, like a massive factory, every new dollar of revenue beyond the break-even point is highly profitable because the factory is already paid for.
So if they can quadruple the output of the ACE facility without deploying new capital to expand the building, their fixed costs literally haven't changed.
Right. Therefore, almost the entirety of the gross margin on those new air handlers falls straight to the operating profit line.
A 50% operating leverage means for every incremental dollar of new revenue, 50 cents becomes pure profit. It's an incredibly potent financial dynamic to have in your portfolio.
It proves they are not just passively riding a macro demand wave. They are fundamentally engineering a more profitable enterprise internally.
And that execution gives them the foundation to navigate the next major technological pivot, which absolutely dominated the analyst Q&A session.
The liquid cooling transition.
Exactly. We've talked extensively about the physics of air cooling and its limitations. The Wall Street analysts were heavily focused on what happens next. And the answer is a massive transition to liquid cooling, specifically through CDUs, or cooling distribution units.
The CEO dropped a remarkable statistic here. JCI's CDU pipeline has already reached $1 billion.
And they're only just beginning to ship these units this quarter, following a formal certification from NVIDIA. Hitting $1 billion before you even really start shipping is wild.
The transition from air to liquid in the data center is arguably the most significant architectural shift in the industry's history. We established earlier that air is a terrible conductor of heat.
Right. But water, or engineered dielectric fluids, have a specific heat capacity that is drastically higher than air.
Liquid can absorb and transport thermal energy thousands of times more efficiently by volume. If air cooling is like sitting in front of a fan on a hot day, liquid cooling is like plunging directly into a cold swimming pool.
The heat transfer is immediate and absolute. That's a great way to picture it.
And as rack densities push past that 100 kilowatt mark we talked about, liquid cooling isn't just nice to have, it becomes non-negotiable.
And the CDU acts as the critical bridge in this new architecture, right?
Yes. You have the facility water loop, the massive pipes carrying chilled water throughout the entire building. And then you have the IT water loop, which is the highly refined liquid circulating directly through the cold plates mounted right onto the GPUs.
So the CDU sits between these two separate loops.
Exactly. It is a highly sophisticated heat exchanger. It's equipped with pumps, filtration, and intelligent controls to perfectly regulate the flow and temperature transfer, but it never mixes the raw facility water with the delicate IT cooling fluid.
It functions like the cardiovascular system of the data center, pumping the coolant directly to the hottest organs, the chips absorbing the thermal load and circulating it out to be chilled and returned.
And reaching a $1 billion pipeline for a product that is barely out of the gate illustrates the sheer panic among hyperscalers to secure this specific technology. They know they can't scale without it.
But the evolution of the physical infrastructure isn't just about the cooling medium, right? It's also about the geography of the compute. And this leads to a fascinating philosophical divergence discussed during the call.
The Armada partnership.
Yes. An analyst asked about JCI's collaboration with a company called Armada to deploy modular data centers. The CEO described these as, essentially, data centers packed into a standard shipping container.
Right. They are pre-integrated with all of JCI's thermal management technology. They provide a couple of megawatts of compute, and they can be dropped into almost any location on Earth.
Which felt like a glaring contradiction to me. The entire industry narrative is all about consolidation. Google, Microsoft, AWS, they are building 1 gigawatt mega campuses spanning hundreds of acres. Why is JCI suddenly pivoting to dropping shipping containers in remote locations?
Because the mega campus model is hitting a very real geographical wall. finding a single location with access to massive fiber optic pipelines, abundant water for evaporative cooling, and a utility willing to guarantee a gigawatt of steady baseload power, it's becoming nearly impossible.
So there just isn't enough prime real estate that meets all those crazy requirements.
Exactly. Furthermore, local communities are aggressively pushing back against these mega projects now, citing major concerns over grid stability and massive water consumption.
So the sheer scale of the hyperscale model is basically suffocating itself.
That's a good way to put it. The CEO articulated a vision of decentralization. While the mega campuses will absolutely continue to exist for training massive foundation models, the deployment of AI requires edge computing.
The inference workloads, right?
Yeah.
When the AI is actually being used in real time.
Yes. If you have an automated oil rig in the Permian Basin, or a sovereign defense installation, or an advanced manufacturing facility, you simply cannot rely on data traveling thousands of miles to a centralized cloud and back.
The latency is too high, and honestly, the data sovereignty risks are probably unacceptable for a defense client. You need localized, dedicated compute right there on site.
It's highly analogous to the evolution of the power grid itself. We spent a century building massive, centralized coal and nuclear plants that transmitted power across thousands of miles.
But now, the grid is moving toward decentralized microgrids, rooftop solar, and localized battery storage to reduce transmission loss and improve resilience.
JCI is betting heavily that AI infrastructure will follow the exact same decentralized trajectory. And strategically, the modular approach is brilliant for their bottom line.
Because they own more of the actual container.
Exactly. When they equip an Armada shipping container, they aren't just selling a single chiller component. They are engineering and providing the entire encapsulated ecosystem. The cooling, the controls, the fire suppression, the physical security.
Oh, I see. They capture a much higher percentage of the total capital expenditure per megawatt of compute in a modular setup than they do when they just sell parts to a sprawling warehouse.
It's a massive upsell masquerading as convenience for the client.
Okay, this deep dive has heavily emphasized the operational victories and the technological moats. But we are analyzing corporate financials here, and no earnings call is a pure victory lap.
Nor should it be. Investors need to know the risks.
Right. To extract the real actionable insights, we have to look closely at the friction points. Where did the Wall Street analysts focus their skepticism during the Q&A night?
The primary interrogation centered squarely on supply chain resilience. An analyst named Nigel Coe directly challenged the CEO on this front.
Because with a $21 billion backlog and the entire industry fighting for the exact same raw materials and electrical components, how is JCI insulated from the bottlenecks that are severely delaying their competitors?
The CEO leaned heavily on the concept of vertical integration to defend their position. He argued that because JCI manufactures the 5 core subsystems of a heavy commercial chiller internally, they essentially control their own destiny.
Let's scrutinize that claim, though. What exactly are those 5 subsystems, and does manufacturing them internally actually protect a company from global macro shocks?
A commercial chiller fundamentally relies on a compressor, a condenser, an evaporator, an expansion valve, and the proprietary digital control systems.
Okay, those 5.
Now, many infrastructure companies out there are essentially just assemblers. They buy the compressor from a specialized vendor in Germany. They buy the heat exchangers from a facility in Mexico, the logic boards from Taiwan, and they just bolt them together in the US.
Which means if any one of those global nodes goes down due to a labor strike, a shipping bottleneck, or a geopolitical event, their entire assembly line just halts.
Exactly. The weakest link dictates the pace of the whole chain. By maintaining vertical integration over those 5 core components, JCI removes massive layers of external dependency.
Okay, but they aren't totally immune, right? They still need raw materials.
True, and the CEO did temper his claim with a dose of realism. He jokes that they don't exactly mine the iron ore out of their own parking lot. They still rely heavily on external vendors for raw commodities and basic electrical switchgear.
He even admitted he occasionally has to personally intervene to unclog certain vendor bottlenecks.
Right. But having sovereignty over the core intellectual property and the manufacturing of those critical path components provides a structural buffer that pure assemblers simply don't have. It's a huge competitive advantage.
That structural advantage seems clear in their HVAC operations, but the actual numerical weak spot on this earnings call appeared in an entirely different division. Their security portfolio.
Yeah, that was the one glaring red flag in the numbers.
The service backlog in the Americas actually experienced a slight decline. In a quarter defined by explosive double-digit growth everywhere else, a contraction anywhere acts as an absolute magnet for analyst scrutiny.
And the CFO addressed it directly. To his credit, the drag was isolated within their security business, which encompasses things like basic fire detection and standard commercial security systems.
He conceded that this specific segment is, quote, less differentiated than their advanced thermal management portfolio, which is a very polite corporate way of saying it has become a total commodity business.
It really has. When you are selling a proprietary AI Factory Absorption Chiller that unlocks millions of dollars of compute capacity by exploiting waste heat, you have an impenetrable moat.
You are a monopoly of one in that specific interaction. They have to pay your price.
But when you are just bidding to install standard fire alarms or security cameras in a suburban office building, you are competing against dozens of competent regional players.
The technology is totally standardized. Therefore, the only way to win the contract is to lower the price, which compresses the margins and drives down the backlog value. It's a race to the bottom.
It perfectly illustrates the dichotomy within legacy industrial conglomerates. Parts of the business are riding secular megatrends, printing money, and other parts are just grinding out single-digit margins in highly saturated, boring markets.
The CFO indicated they were restructuring that organization to focus on higher value integrated solutions. But he was transparent that it will not be the growth engine for the enterprise anytime soon.
No, it's a drag they just have to manage.
Which brings us to the final and perhaps most nuanced financial headwind they discussed in management guidance: the shifting sales mix between systems and service.
This is a really important dynamic for long-term investors to grasp.
They break their revenue down into two primary buckets. Systems revenue is generated by selling and installing new physical equipment. Service revenue comes from the long-term contracts to maintain, repair, and optimize that equipment over its lifespan.
Right. And currently, because of the massive data center build-out, their systems business is significantly outpacing service. Systems grew 11%, while service only grew 7%.
On the surface, growth in both categories is obviously positive. However, the CFO pointed out a structural mathematical reality. The installation of new systems carries slightly lower profit margins than the recurring service contracts.
So as the lower margin systems business becomes a larger percentage of their total revenue pie, it mathematically creates a slight drag on their overall blended profit margin.
But this is where the short-term financial mechanics mask the long-term strategic brilliance. This is the classic razor and blades business model operating on a massive industrial scale.
Exactly. You sell the razor, the physical chilling system, at a respectable margin today. But that system is incredibly complex and absolutely mission critical.
The data center operator cannot afford for it to fail for even an hour. Therefore, they are practically obligated to sign a long-term, high-margin service contract, the blades, to ensure JCI technicians maintain it for the next decade.
It is the ultimate industrial flywheel. Every single data center cooling unit JCI ships today is essentially a Trojan horse for a highly lucrative, recurring revenue stream tomorrow.
And the CFO explicitly modeled this out. He stated that as their data center exposure grows to a projected 1/3 of their total revenue over the next 3 to 5 years, they are vastly expanding their installed base.
Crucially, they are also improving their service attachment rate, meaning they are successfully converting a higher percentage of these new system sales into binding service agreements immediately.
So what Wall Street models as a minor margin headwind today is actually the company burying deep structural roots for massive profitability in the future.
They are gladly trading a fraction of a percent of margin now to secure a decade of high margin recurring cash flow. It is a phenomenal demonstration of sacrificing short-term optics for long-term compounding value.
Okay, let's look at the bottom line. We have mapped an incredible landscape today. We started with the abstract concept of artificial intelligence and dragged it down into the physical reality of thermodynamics, power grids, and chemical absorption cycles.
We examined how Johnson Controls is leveraging a 140-year industrial legacy to position itself at the exact defining bottleneck of the digital era.
We've traced the evidence through their financials. The 35% EPS expansion, the $21 billion de-risked backlog, and the ruthless operational efficiency of that Gemba business system.
That operational leverage is what really stands out to me. Quadrupling capacity without diluting margins is the hallmark of a great management team.
And we explored the architectural future of the industry. The mandatory pivot to liquid cooling CDUs as rack densities push into the extreme, and the structural shift toward decentralized modular edge computing to bypass the limitations of an exhausted electrical grid.
The core takeaway for investors is a total reframing of the AI narrative. When you observe the market reacting to a new foundational model or a breakthrough in chip design, the natural instinct is to just look at the software layer.
Right, to buy the software stocks. But this deep dive reveals that the true execution of that technology is entirely dependent on the physical infrastructure that supports it.
The invisible governor on the engine of our digital future is heat.
Which leads us to a profound, unresolved tension that underpins everything we've analyzed today. We know companies like JCI are executing brilliant engineering feats, using waste heat to drive cooling, cutting electrical demand by 44%, dropping modular containers into remote energy pockets.
But the thermal and electrical demands of these AI models are growing exponentially, while the physical capacity of our global infrastructure is growing linearly at best.
The gap between the demand for power and the physical reality of the grid is widening every single day. So what happens when we exhaust all the engineering efficiencies?
That is the trillion-dollar question.
What happens when a 44% reduction in cooling power still isn't enough to balance the grid? We are approaching a threshold where the availability of thermal management and raw electricity will literally draw the geographical map of AI advancement.
It becomes a physical land grab for power and cooling.
Will the companies that control the industrial plumbing, the cooling distribution units, and the modular microgrids ultimately hold veto power over where and when the next generation of artificial intelligence can actually be turned on? The bottleneck isn't just a technical challenge anymore. It is rapidly becoming a matter of sovereign infrastructure capability. Keep questioning the physical foundations of the headlines you read, and thank you for joining us on this deep dive.